What happened? While everyone slept, silver didn't slowly correct. It was surgically torn apart in the night. The price plunged from the mid-80s to the low 70s in minutes. That's not a market digesting news. That's an engineered collapse. I'm your host. Welcome. Stay focused. I'll break this down step by step with clear indicators to watch and tactical moves you can use immediately if you decide to act. I'll mark entry, size, and exit rules. At roughly 2:01 a.m. Eastern, in the thinnest slice of trading liquidity all year, a single massive position hit its maintenance margin and was forcibly unwound. This was not emotional selling. This was an automated liquidation, a risk engine with one order, get out, that executed into an empty market. When the book is empty, algorithms stop being financial tools and become wrecking balls. They don't nibble at the market. They tear through it until they find bids, and they found none until the price hit the low 70s. Think about that for a beat. Who trades hard into the night of a holiday week? Retail? No. Traders on vacation? No. This was institutions, a leveraged counterparty whose losses cascaded into execution. When an institutional account breaches its maintenance, it isn't politely warned, it's auto-liquidated. The algorithm doesn't whisper, it sells until the ledger balances. On that lonely early morning, the engine sold through thousands of contracts, searching for liquidity that simply wasn't there. A red candle on the chart isn't truth, it's the footprint of a violent mechanical event. The seller didn't choose the bottom. The seller had been chosen by math. Voluntary selling from investors signals a change in conviction. Forced selling because a levered player blew up is a purge of weakness. The market expelled a massive, fragile position. When the dust settled, the leverage that amplified moves was gone. The system was cleaner. The path higher became shorter. But the liquidation was only the first act. A second mechanism turned the dump into a massacre, the negative gamma spiral. As price fell, dealers and option books that were short premium found their hedges flipping. Negative gamma forces dealers to sell into weakness to remain hedged. Price down, dealers sell more. Price down more, dealers sell yet again. The dealer hedges became an accelerant. The market stopped being a place where buyers and sellers meet, and instead became a feedback loop of forced selling. This is critical. The cascade amplifies itself until it hits real limits. Why did it stop at the low 70s and not keep drilling? Because the plumbing arrived. At about 3:15 a.m., clearing and settlement systems flagged a counterparty shortfall. If the clearinghouse was left holding the loss, the ripple would freeze the entire futures market. When that happens, emergency lines are opened. Not press conferences, not speeches. Repo and swap lines move in the dark. Liquidity was injected to ensure the rails kept running. That cash didn't buy ounces. It simply patched the ledger so trades could settle. The rescue didn't change fundamentals. It fixed the mechanical risk of a market implosion. It proves one thing: the paper market is fragile. It is a matrix of leverage and promises sitting on top of a finite stock of metal. When a large levered position blows, it can compromise that matrix. The central bank intervened not to prop a price, but to prevent systemic failure. Now follow the metal. While paper contracts were being shredded in the West, Asia, the physical demand center, behaved differently. Shanghai did not mirror the crash. The front-month physical contract in Asia held far higher. That divergence is the smoking gun. In a functioning global market, arbitrage closes gaps. That gap opened because metal cannot move freely anymore. Export windows, licensing, and logistics are constraining flow. The West displayed a busted paper price. The East showed a market that still needs metal and will pay up for it. Concretely, New York's paper price plunged into the $70 range, while Shanghai's physical contract printed close to $90 per ounce equivalent. A double-digit spread on a globally used industrial commodity is not a trivial arbitrage mismatch. It is evidence of broken market structure. Traders can't just buy cheap paper in one place and sell expensive physical in another when the metal itself is trapped. There's another telling behavior. Vault withdrawals spiked before the crash. A large coordinated removal of metal from major warehouses occurred in the hours ahead. That is not retail panic. That is intent. Buyers converted paper claims into actual bars. They took delivery because they saw the book was vulnerable. When smart players drain the shelf before the show begins, you don't conclude supply is abundant. You conclude someone with resources is securing tangible ounces, which brings us to the mainstream narrative, retail panic, and why it's false. Flow data shows retail investors were buying the dip. ETF inflows rose. Bullion dealers reported surging traffic. It wasn't mom and pop abandoning ship. The sellers were levered institutions and dealers hedging under stress. So when the networks blame the little guy, remember, data contradicts that claim. The retail buyer was the quiet lifeboat while the casino's leveraged player imploded. This purge removed a huge overhang of leverage that matters more than the immediate price. When a monster position is liquidated, the market loses amplified downside pressure. That creates an asymmetric opportunity, a mechanically suppressed price with intact physical demand. Volatility can be the entry point, not the exit sign. So what happens next? 3 things to watch and an urgent timing window. First, the institutional trading desks return from holiday. They will see a large discount between paper and physical. Second, physical withdrawals may continue as buyers hoard real metal. Third, the repo and settlement plumbing will be watched for renewed stress. The timing is immediate. When desks reopen with capital and mandates, the vacuum fills fast. Institutional flow tends to be decisive. If allocators and commodity desks see a persistent physical premium, they'll move pockets of capital quickly. Expect violent mean reversion toward the physical market once discretionary money acts. That can overshoot. The forced sellers were out at the bottom. Discretionary buyers stepping in together can create a rapid squeeze. But remember the central fact. Liquidity injections fix the ledger, not the vault. No emergency loan prints an ounce. The physical world, miners, refineries, factories, didn't get more material because the Fed flooded the system. That means the gap between ledger liquidity and metal remains the core opportunity and the core risk. If you hold physical, your position is cleaner. You aren't the levered counterparty that blew up. If you hold only paper, you depend on the health of counterparties and the exchange rails. Trade rules now prioritize custody and optionality. Custody means allocated, insured, transferable metal under a reliable custodian. Optionality means the ability to convert ounces to liquidity without a single congested redemption window. In stressed markets, delivery timelines and refinery acceptance matter. Diversify storage points and know who will take your bars at melt value. Traders should trade the return of institutional flow, not the emotional noise. The trade concept is simple. Buy dislocation with physical backing. But execution is nuanced. Aggressive players front-run flows. Conservative ones scale. Size matters. Don't replicate the mistake of the forced seller by using leverage to chase the bounce. For equity exposure, focus on miners that are unhedged. Companies that sold forward production at fixed prices will not benefit from a rally. Pure silver producers with minimal forward sales have operating leverage that expands dramatically as spot rises. Governance and jurisdiction are critical. A high-grade asset in a stable country outranks a marginal project in a risky one when premiums spike. Risk frameworks need overhaul. VAR models tuned to calm markets fail during mechanical events. Add tail scenarios, overnight gaps, counterparty default, and clearinghouse stress. If your stress tests don't include ghost week liquidations, your model is blind. Narrative traps will be deployed by the media and talking heads. They'll frame this as a busted bubble or retail panic. That is convenient blame. The truth, a mechanical liquidation of leverage and a subsequent central bank liquidity patch revealed systemic fragility. Don't confuse the method of price movement with a change in underlying demand. Derivatives are another battleground. Expect implied vol to rise and remain elevated until the market digests the new regime. That makes some option strategies expensive, but also creates opportunities if you have balance sheet capacity to sell premium responsibly. Geopolitics will matter. If withdrawals continue and premiums persist, governments might invoke export controls or strategic allocations. When metal is scarce and critical for industry, policy becomes a price dynamic. That would widen the split between accessible and restricted supply and could push domestic prices even higher. Here are the 4 metrics to watch now: warehouse withdrawals, Shanghai premium, ETF flows, and repo spreads. If withdrawals continue and the Shanghai premium holds or widens, the physical market is still hungry. If ETF inflows persist, retail conviction remains strong. If repo spreads calm, the plumbing is repaired. If they re-widen, systemic risk persists. These signals will tell you whether the reset was a one-off or the start of a structural regime change. Expect the narrative machine to try emotional warfare. Fear-inducing headlines, sell now language, and scapegoating. The best defense is process. Predefine entries, size risk sensibly, and set non-emotional stop rules. The market that punished leverage will not be forgiving to those who reintroduce it imprudently. A short scenario map. Base case. Forced liquidation contained, retail absorbs, institutions buy the dislocation, fast rebound. Structural case. Continued withdrawals, export constraints, and premium persistence leading to extended scarcity. Tail case. Multiple counterparties fail, policy interventions broaden, and markets remain dislocated longer. Prepare for the range, not a single narrative. 2 quick questions. Drop 1 in the comments now. Did you add to your position during the drop or sit on the sidelines? And if you were allocating new capital, would you choose bars, miners, or options? And why? I'll read the best answers and respond. If this breakdown cut through the noise, do one quick thing. Subscribe. Short and simple. Subscribe for clear, no-fluff market analysis when it matters. If you want the follow-up, I'll publish a live update within 48 hours showing the next warehouse report and the Jan 2 order flow. Hit subscribe and the bell. Remember, what we saw was an engineering failure of leverage, not a collapse of demand. The banks and the plumbing caught the system before it broke, but they didn't create metal. The physical buyers used the chaos to acquire ounces. That is the real story. The reset is not the end. It's the beginning of a new chapter where physical ownership and thoughtful risk management will be rewarded. Watch the inventory, watch the premium, watch the calendar. Be ready when the desk's returned. Be patient, be cautious, and hold the metal you can touch. The next move will be violent and decisive.